Hello, I'm Dr. Wendy Teets. Welcome to today's Accounting in the Headlines. Today we're going to be talking about Target Corporation, the data breach, and contingent liabilities. Background. In the fourth quarter of 2013, hackers broke into Target Corporation systems and stole the names and credit card information for up to 70 million customers. This data breach is among the largest data breaches in U.S. history, and lawsuits against Target Corporation are being filed by several parties, including customers, credit card companies, state attorneys general, and others. The financial effects of the data breach at Target is a good opportunity to see how contingent liabilities are accounted for under U.S. GAAP. To follow are excerpts from Target Corporation's 10-K for 2013. My source is Target Corporation, SEC filings, 10-K filed March 14, 2014, notes to financial statement, pages 46 and 47. We're going to look at specific excerpts from the notes. I note that I have indicated omitted words and phrases by 3 or 4 dots after something. So the first excerpt we're going to look at reads, in the fourth quarter of 2013, we recorded 61 million of pre-tax data breach related expenses and expected insurance proceeds of 44 million for net expenses of 17 million, 11 million after tax. These expenses were included in our consolidated statements of operations as selling, general, and administrative expenses, SG&A. Expenses include costs to investigate, provide credit monitoring services, increase staffing in our call centers, and procure legal and other professional services. Now going on to another excerpt from the same notes. The 61 million of fourth quarter expenses also include an accrual for the estimated probable loss related to the expected payment card network's claims by reason of the data breach. The ultimate amount of these claims will likely include amounts for incremental counterfeit fraud losses and non-ordinary course operating expenses such as card reissuance costs that the payment card networks believe they or their issuing banks have incurred. Currently, we can only reasonably estimate a loss associated with settlements of the network's expected claims for non-ordinary course operating expenses. The year-end accrual does not include any amounts associated with the network's expected claims for alleged incremental counterfeit fraud losses because the loss, while probable in our judgment, is not reasonably estimable. We believe that it is reasonably possible that the ultimate amount paid on the payment card network claims could be material. And then the final excerpt we're going to look at is state and federal agencies, including the state attorneys general, the Federal Trade Commission, and the SEC, are investigating events related to the data breach, including how it occurred, its consequences, and our responses. Although we are cooperating in these investigations, we may be subject to fines or other obligations. While a loss from these matters is reasonably possible, we cannot reasonably estimate a range of possible losses. We do not believe that a loss from these matters is probable. Therefore, we have not recorded a loss contingency liability for litigation claims and governmental investigations in 2013. Now let's review the accounting treatment for contingent liabilities under U.S. GAAP FASB guidelines. FASB provides guidelines for accounting for contingent liabilities, including 1. Accrue if the loss/expense is probable and the amount can be reasonably estimated. 2. Disclose if it is reasonably possible, which is less than probable but more than remote, that a loss/expense will occur. And 3. If the loss expense is unlikely to occur, there is no need to report or disclose. Now let's apply this to Target's situation. What we see in the excerpts from its 10-K is that Target Corporation is acknowledging at least 3 possible liabilities resulting from this data breach. 1. A liability to the credit card companies for the expenses associated with credit card reissuance and other operating expenses. 2. A liability to the credit card companies for the losses resulting from fraudulent use of the stolen credit card information. And 3. A liability for fines or other obligations from regulatory agencies. Let's look at each one of these separately. Credit card reissuance expenses. Target acknowledges in its 10-K that it is accruing for the liability related to the expenses associated with credit card reissuance and other operating expenses. Target specifically states that the loss related to credit card reissuance is both probable and the amount is reasonably estimable. The amount of liability for these expenses is found in the current liabilities on Target's balance sheet, and the related expense is on its income statement. Next, looking at fraudulent use of stolen credit card information losses. Target then goes on to state that while losses from the fraudulent use of the stolen credit card information are probable, the amount of these losses cannot be reasonably estimated. Target is therefore making no accrual for these potential losses in the fourth quarter of 2014. These probable losses do not appear in Target's balance sheet, nor do the losses appear in its income statement, but the losses are disclosed in the financial statements. Finally, Target discloses that fines or other penalties from regulatory bodies are reasonably possible, but the amount of such penalties is not reasonably estimable. Therefore, Target only discloses the possibility of fines in the notes of financial statement, no appearance on the balance sheet or income statement. So that's it for today's look at a 10-K. Have a great day.